Welcome back to Miller Momentum. I'm Jeffrey Miller, but back when I taught mathematics at the university, my students often called me Dr. G. If you spend any time on financial YouTube, you've likely come across my arch nemesis, Professor G, and his massively popular three-fund ETF portfolio. It's pitched as the ultimate simple way to get rich. One third in the S&P 500 with VOO or VOO, one third in dividends with SCHD, and one third in a growth fund like SCHG or QQQM. Recently, he's even started bolting on a fourth fund, SPMO for momentum. It sounds incredibly balanced, I'll give it that. You get the foundation of the market, the cash flow of dividends, and the upside of tech and growth. There's just one problem: it's a mess, and it's unlikely to deliver on its promises. It cuts against so much that is known in academic financing and investing. Today, we're going to look under the hood of Professor G's three fund ETF portfolio, look at what the data actually says about dividends and growth, and I'm going to show you a simpler two fund alternative that actually achieves what this portfolio, Professor G's portfolio, is trying to do. And this two fund ETF portfolio achieves it very, very well. But I won't just stop there. It'll be revealed that this two fund ETF portfolio is the building block from which the Miller Momentum three fund ETF portfolio was built. And that three fund ETF portfolio for Miller Momentum is now called the Zenith portfolio because I like fancy cartographic terms that also have some degree of majestic mythological weight. Well, let's dive right in. But first, a quick disclaimer: I'm not a financial advisor, and this is not financial advice. The content in this video is for entertainment and educational purposes only. Past performance is not indicative of future results. Statements made are my opinions. Investing involves risk. Always do your own research. Now, why am I making this video? Yes, to share my own investment strategies as usual, but also because I want to help people avoid gimmicks on YouTube. I don't want to speculate on Professor G's intentions or aims, but it is a fact that his highly concentrated, US only, large cap only portfolio may not be appropriate for many of the investors he's advocating it for. I also find his prices exploitative, and it bothers me how closely his financial coaching business has started bordering on actual investment advice, for which he is not credentialed or qualified to the best of my knowledge. I also don't agree with how he subtly uses the Christian faith in some of his videos to gain the trust of his viewers. And Professor G's viewers do trust him a great deal. I am concerned that their trust is misplaced. I mean, he repeatedly says his three ETF portfolio beats everything, but does it? What if I told you my two ETF portfolio I'm about to get into beats everything? No, it does. Believe me. Best portfolio on the planet, on the whole face of the planet Earth. I mean, just watch it take on Godzilla.
Godzilla is off balance. Defeated, he sinks into the sea.
See? What'd I tell you? Seeing is believing, right? Okay, fine. The two ETF portfolio of SPMO and VBR is not the perfect portfolio because there is no such thing as a perfect portfolio. But it is an effective implementation of the strategy Professor G is trying to do. To understand why, though, you first need to understand what's wrong with Professor G's three ETF portfolio. The Professor G portfolio consists of four components. First, VOO, the S&P 500 ETF, and Professor G holds that approximately as one third of the portfolio. Then SCHD, or SCHD as he likes to call it, the Dividend ETF, which is historically again, one third of his portfolio. And then, depending on which video you watch, he recommends SHUG, SCHG, or QQQM for the large cap growth ETF portion of his portfolio. Again, approximately one third. Although recently he's been bolting on SPMO or SPMO, as some people like to call it, the S&P 500 Momentum ETF. And that has been gradually eating away at his large cap growth allocation here. So, the portfolio that Professor G presents on Investing Simplified is pitched as giving you the foundation of the market, the cash flow of dividends, and the upside of tech and growth. But there are three very serious structural problems with this construction. The first major issue with the Professor G portfolio is the illusion of diversification. So, VOO is the S&P 500, the 500 largest companies in the US. SCHG is large cap growth, and SCHD is a dividend focused fund with significant exposure to large cap, high quality companies. When you buy all three of them together in the same basket, you aren't actually diversifying anything. You are buying a concentrated slice of large American companies in overlapping ETF wrappers. SCHG's top holdings, Apple, Microsoft, Nvidia, Amazon, they're the same names dominating the S&P 500 right now, because both are market cap weighted toward the same mega cap technology stocks. By mixing a large cap growth fund and a dividend fund into the S&P 500, you are also largely reconstructing the large cap US market with extra steps, taking on a slight sector drift and entirely ignoring mid caps, small caps, and international markets. You might as well just hold 100% in VOO or another S&P 500 fund and save yourself the trouble. Indeed, that actually isn't a bad investment strategy if you are absolutely convinced of continued US dominance. But what about the dividends? SCHD gets strong ratings from Morningstar, and dividend investing is practically a religion online right now. But here's the hard truth. Dividend investors don't want to hear this. Dividends are actually irrelevant to your total return. Dividends don't matter. They just do not matter. When a company pays a dividend, the stock price drops by approximately the amount of the dividend on that ex-dividend date. In practice, it often drops by slightly less due to tax and market microstructure effects, but the core point holds here. Dividends are not free money. A dividend is a partial liquidation of your equity, a partial forced liquidation on the company's schedule, not yours. In a taxable account, it creates a taxable event, whether you want it or not, and it limits the company's ability to compound that cash internally by investing it in the company. If your goal is protection during rough economic times or stable cash flow, you shouldn't be targeting dividends. In my opinion, you should be targeting the Fama-French value factor directly, which brings us to the biggest structural flaw in Professor G's three-fund ETF portfolio. In the Fama-French factor model, one of the most widely used frameworks in quantitative finance, growth is not a factor premium. I'll repeat that. Growth is not a factor premium. Growth is actually an anti-value bet. Value stocks, in the Fama-French sense, are companies that are cheap relative to their book value. Growth stocks are expensive relative to their book value. When you pair a dividend and quality fund like SCHD, which is targeting value indirectly, with a large cap growth fund like SCHG, their factor exposures substantially offset each other. You are stepping on the gas and the brake at the same time while trying to drive forward. Your value and growth tilts largely cancel out when they're used in the same cap size. And you are dragged back toward the standard market beta. Again, you've basically reconstructed the behavior of the S&P 500. Professor G recently started adding SPMO and S&P 500 Momentum ETF as a piece of this portfolio of his. Now, momentum is a fantastic factor. I mean, just look at the name of my channel. But throwing it into a pile of overlapping large cap funds just further muddies the waters. If you actually want to capture market outperformance using factor investing, you need assets that complement each other. Momentum and value have historically had low or even negative correlation at the factor level. That means they tend to take turns working rather than rising and falling in lockstep. So here's how you actually build this portfolio. The portfolio Professor G is trying but failing to build. You put 50% in a momentum fund like SPMO and 50% in a small cap value fund like VBR. Instead of three overlapping large cap funds, you use just two. 50% in that SPMO ETF for your momentum exposure, and 50% in a fund like VBR for your small cap value. You rebalance once a year. That's it. Investing simplified. I mean, actually simplified. Well, at least if you have no doubt in the continued US dominance of the market and want an all equity portfolio, but that's a very different concern. Many intelligent and well informed investors want a very simple all USA equity portfolio, and you may be one of them. If you are, the important thing is to do it right in the way that will actually make you the most money from your bet. Why does this 2 ETF portfolio work? Well, because momentum and value have historically had low or negative correlation as factors over long time horizons. When trend following is rewarded and growth expectations are running hot, your momentum fund captures that upside. When the cycle rotates and valuations compress during trend reversals, cheap small cap companies have historically offered better long run premiums, and they give your momentum allocation time to adapt and catch up. Now, two more things you need to be honest with yourself about before building a portfolio like this. First, small cap value stocks carry higher market beta than large caps. That means during a severe broad market downturn, 2008 to 2009 is the cleanest example of this, they tend to fall harder. This pairing is about factor diversification over a full market cycle. It is not a crash hedge. Value is not a crash hedge. Dividend is not a crash hedge. I know Professor G has billed value and dividend ETFs as safe, bond-like allocations or even bond-like replacements, but he's wrong. They tend to fall harder than the broad market when they crash. Second, momentum is prone to sharp, fast reversals when trends break. The 2009 momentum crash is the most studied case of this, but the dot-com crash would have been a much bigger deal for SPMO. You need to be able to hold through those episodes without panicking out of the position. That's why momentum and value make such a powerful combination, because the safety feature doesn't arise from either fund, but rather from their mutually supportive interactions. And one more structural disclosure. The US value premium went through a very difficult period from roughly 2007 to 2020, producing negligible returns as a factor during that stretch before recovering in the early 2020s. That doesn't mean that value ETFs and value funds didn't return anything. They did, but there wasn't an extra value premium as expected on top of that. Factor premiums can underperform like this for extended periods. That's not a reason to abandon a sound strategy. In fact, it's just part of the behavior of these factors. But it is a reason to go in with accurate expectations of what you could experience during your investing journey. If you want to take this further with broader factor exposure and a stricter profitability screen, you can swap the tickers in this 2 ETF strategy. Go 50% MTUM for momentum exposure across large and mid cap US stocks, and 50% AVUV for a more aggressive rules based small cap value tilt with a profitability filter. This combination has historically delivered strong risk-adjusted returns relative to a simple S&P 500 holding over long periods, with significantly higher absolute returns too, but with higher volatility and slightly more severe drawdowns than a total market approach. The same caveats about extended factor underperformance and momentum crashes apply here. So investing doesn't have to be complicated, but it does have to make mathematical sense. Don't buy funds just because they have a great 5-year backtest on a YouTube video. Understand the factors you are buying, eliminate overlap, and let the data drive your strategy. And speaking of data, let's take these strategies out for a test drive, shall we? Now, the cool thing about SPMO and VBR is that they are both index funds with well defined methodologies. And since we have stock trading data going back, oh, really reliably until 1972, we can reconstruct exactly what these funds would have returned and see what these strategies would have yielded over the past half a century. So, first of all, to test, I've got our momentum plus small cap value lined up. And then I've got momentum by itself, SPMO, and small cap value, VBR. And by momentum, I mean US large cap momentum to be precise. And we're going to compare all of these three against the S&P 500. When we run the stats, we can see that while momentum and small cap value do outperform the S&P 500 on their own, when they are combined, they actually outperform each other in a 50-50 mix with a lower max drawdown than the S&P 500, a lower average drawdown than the S&P 500, a much shorter longest drawdown, improved volatility, and a much improved Sharpe ratio. Indeed, this market beta for a combined 50-50 approach is only 0.91. So it's really good. And you can see down here with the strategies compared that momentum plus small cap value, it stacks momentum and small cap value returns pretty much because of that uncorrelated relationship between them. Indeed, that negative relationship during hard times. So when we look at the logarithmic scale here, we can see very clearly that momentum plus small cap value is in the lead. It follows small cap value pretty much for most of its history, but with improved volatility. Now, I want to show you exactly how closely related the three fund portfolio that Professor G advocates is to the S&P 500 and show you how it lines up. So historically, VTV is the Vanguard index for large cap value. So we can backtest exactly what that looks like, a large cap value fund with Professor G's strategy. VUG is large cap growth. So we can backtest that. And VOO is just the S&P 500. So we can backtest that too against our existing strategies here. So we'll just run a new backtest in testful.io, and it only takes a second. And we can see here that Professor G's three fund ETF portfolio is actually pretty much identical to the S&P 500 over long time horizons. Indeed, look how closely the teal and the purple line are to each other. It's quite remarkable. In fact, over the long run, the S&P 500 wins slightly against the three fund portfolio because, well, it's a cleaner strategy and a cleaner approach. But as you can see, the promise that Professor G is making, it's not panning out here. What he's giving you is just the S&P 500. If you want an approach that actually gets you above the S&P 500, an approach that does have some resistance to long drawdowns built in, that would be momentum plus small cap value. Cuz look, with the longest drawdown that you can have with the S&P 500 and the three fund portfolio over the past 52 years is almost 7 years, and compare that to momentum plus small cap value at just shy of 4 years. So that's substantial improvement there. And not only that, look at how much more of a return you're getting by combining momentum and small cap value. I understand what Professor G is trying to achieve here, but it's just not working for him, and it won't work for you. Now, if you've watched my channel before, you know I love uncorrelated alternative investments, especially managed futures. So, despite the strong performance history of strategies like SPMO plus VBR, drawdowns of 53% with 4-year recovery periods, while much better than the S&P 500, aren't good enough for me. I'd rather run a much more robust, resilient portfolio that still meets or beats the market on its own. And if I want higher return, I'll just apply very modest leverage, like 1.25x, in a brokerage account and say M1 Finance. And that brings me to the Zenith portfolio, my take on a 3 ETF fund portfolio with a focus on the US. So on the left, I have the momentum plus small cap value portfolio that we just tested, the 50-50% mix. And on the right, I have the Zenith portfolio. And for this, I've chosen to use MTUM in combination with Avantis's AVUV. For the backtest for that, I've just used the DFA firm's an analogous fund to AVUV, which is DFSVX, which is their small cap value portfolio, and I've backfilled that with VBR to take it a little bit back in time before 1999 to get back to 1994. And I've put 40% in managed futures. So you would think that by reducing your equity share to 60% of a portfolio would actually decrease your returns. That's not always necessarily true, because the brilliance of this 3 ETF fund mix is that all three of these allocations are completely and entirely separate. There's no overlap going on here. Now, DBMF can go long or short on US stock futures. It can bring in long or short positions in international stock if there's ever a period when that excels. So you get automatic diversification in a dynamic way there. But it also goes long or short across commodities, currencies, and rates. So that's really cool. When you back test it, look at this. The momentum plus small cap value all equity portfolio. Um, its compound annual growth rate is fairly comparable to the Zenith portfolio, which only takes 60% in stocks. But the max drawdown of that more diversified portfolio that brings in managed futures is just a fraction of the max drawdown of an all equity portfolio at negative 34.31%. Its average drawdown is about half. Its longest drawdown is under 3 years. And look at the volatility. It's around 12% with a Sharpe ratio of 0.78%. Look at the beta here. It's dropped to 0.55. That means that its movements are roughly about half those of the market, so half as severe. Whereas your momentum small cap value all stock mix is roughly at the market's beta level. And we can see that the Zenith portfolio is actually above the momentum plus small cap value for a good portion of the past 32 years. So it's not like you're missing out with this approach. It can be wise to focus just as much on defense in a portfolio construction as on offense, because it doesn't matter how much money you gain during the good times if you lose it all during the bad. The strategy that ultimately wins is the one that can get you gains efficiently based on the risk that you take, not the one that can maximize your gains in the short term. And I think that for people like Professor G, the past 10 years have blinded him to the fact that defense is really important, and you can't get it from the universe of just large cap US stocks. You've got to go beyond that to other uncorrelated assets if you really want to win long term, both in risk adjusted returns and also in absolute returns. The great thing about my Zenith portfolio, Dr. G's three fund ETF portfolio, if you will, my answer to Professor G's three fund ETF portfolio is that the Zenith portfolio is a framework, an architecture. If you don't want all US exposure, you can split the 30% momentum and value allocations between domestic and international stocks if you want, with your preferred funds. If you're in Europe, you could try something like 30% IWMO, 30% IWVL, or an equivalent to AVGV, and 40% DBMF. There are so many variations you can make on this basic architecture based on your own needs and preferences. And that's exactly what I want to give you on this channel. Frameworks for success that have arisen from my own experience and experimentation that you can then adopt and adapt as your own for your own unique situation. We are in a conversation together, collaborating, learning and exchanging ideas to become better investors. That's my approach. That's my philosophy. While I may eventually offer services or fun channel swag, you know, cups, promo t shirts, we can do some funny things. It'll be great. Or whatever. I'm not an authority above you. I am a fellow learner and traveler. And I'm out to share my knowledge and expertise, and I welcome your sharing of knowledge and expertise as well. Thank you for watching Miller Momentum. If you enjoyed this video, don't forget to like and subscribe, and leave me a comment with questions or concerns. I always love engaging with my viewers. Until next time.